had one of those moments where you check your investment portfolio and see a sharp drop and your stomach sinks? Oh no, my investments are down 10%? Should I sell? Or like the opposite? Wow, everything's skyrocketing. Should I buy more before I miss out? If you have been through this emotional roller coaster, you are not alone. Most investors panic when prices swing wildly, and the reason they confuse volatility with risk. But here's the truth. Volatility is just price movement. It's temporary, and risk is permanent loss. You may never recover from it. Understanding this difference can be the game changer in your investing journey. So let's break it down step by step in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you by simplifying the world of personal finance for you. So now let's get into the video and define volatility, the market's mood swings. Think of the stock market like the weather. Some days are sunny and bright, some days are stormy and chaotic. Most days fall somewhere in between. Just like the weather, the stock market has good days and bad days. So the definition is volatility measures how much an asset's price fluctuates over a certain period. High volatility is equal to bigger price swings. Think like a roller coaster. Low volatility is equal to more stable price, like a calm train ride. And this is key. Volatility is not a guarantee of loss. If a stock drops 10% today but rebounds next week, did you lose money? No. Only if you panic and sell, you lose money. So example is Sensex fell 38% in 2020 during the pandemic crisis. By 2021, it had fully recovered and reached new highs. Investors who stayed invested didn't lose, they gained. So the lesson is volatility is just short-term noise. The real problem is how you react to it. So now let us understand risk, the real threat to your money. Risk is not price swings. Risk is permanent loss. Let's say you invest 10,000 rupees in a stock. The stock drops 20% in a week. That's volatility. The company goes bankrupt and your stock is worth 0 rupees now. That's risk. Risk is equal to losing money permanently or failing to meet financial goals. For example, investing in a shady company that goes under, or betting everything on one stock instead of diversifying your investments, or selling in panic when the market is down. Example, in 2001, tech stocks were booming. Everyone was investing. Then came the dot-com crash. Many companies shut down, wiping out investors' money forever. That wasn't just volatility, that was real risk. So the lesson here is volatility comes and goes, but risk stays forever. Now let's take a look at key differences between volatility and risk. So every investment has some level of volatility, which is the price fluctuations, and risk, which is the potential loss. The key is knowing which asset match your risk tolerance and financial goals. So let's break it down. For one, stocks has high volatility but medium risk if diversified. So stocks are one of the most volatile asset classes, but they also offer the highest potential returns over time. So why invest in stocks? If you are a best long-term wealth creator, it would be best for you because it historically beat inflation. And volatility can be an advantage if you buy during market dips. And also diversification, which is investing in different sectors and companies, will also reduce the risk. The potential risk is investing in a single stock can be risky, because if that company fails, you lose all your money. And also emotional investing, like panic selling during crashes, can hurt your returns. So the lesson is stocks may seem risky in the short term, but if held for 10 plus years, they tend to recover and grow. So now let's take a look at bonds. So bonds have low volatility because prices don't move much, and also low risk because government bonds are stable. So bonds are essentially loans you give to a company or a government and they pay you interest. Government bonds like RBI bonds in India are considered very safe. So why should you invest in bonds? You get stable income through fixed interest payments and less volatile than stocks because it's good for conservative investors if you're looking for low risk investment, and it also protects your portfolio during stock market crashes. The potential risk in bonds is that corporate bonds can be risky if the company defaults, and also inflation risk because bond returns might not keep up with rising prices. So the lesson here is bonds are great for stability but won't give high returns like stocks. Next is real estate, which has medium volatility because property prices fluctuate but are not as wild as stocks, and it has low risk, especially if the location and demand are strong. So real estate is a physical asset that appreciates over time. It's less volatile than stocks but not completely risk-free. Why should you invest in real estate? You can generate rental income, you can get long-term appreciation in good locations, and it can also act as an inflation hedge, which is your property value often rise with inflation. The potential risks are there is liquidity risk because selling property does take time, and market crashes like 2008 can reduce property values, and also it is a high initial investment option because it requires large capital upfront. So the lesson is real estate is less volatile than stocks, but your returns depend on location and demand. And next we have gold, which has medium volatility because gold prices move but not as much as stocks, and also it has low risk because especially if you're buying gold for a long-term store of value, then it has low risk because gold has never lost all its value, and gold is one of the oldest forms of investment. It's used as a hedge against inflation and economic uncertainty. So why invest in gold? It is a safe haven during market crashes because gold prices often rise when stocks fall, and also it holds value over time unlike paper currency, and it is a good portfolio diversifier which reduces your overall risk. And there are also potential risks like no passive income unlike stocks and bonds, and the gold prices can stay stagnant for years, not great for short-term gains. And there are also storage costs if you buy physical gold. So the lesson is gold is not a high growth asset but is useful for stability in uncertain times. Now we have crypto, which has very high volatility because the prices can rise or fall 50% in a day, and it also has very high risk because many cryptos disappear completely. So crypto is a new digital asset class that is highly speculative and unpredictable. So why should you invest in crypto? Because of high potential returns. Some cryptos have given 1000% plus returns, and it is also decentralized, not controlled by governments, and there is a growing adoption in finance and technology for this asset class. The potential risks are extreme volatility, huge price swings in short periods, and the regulatory risk. Governments may ban or restrict crypto, and there are also fraud and hacking risks like many crypto scams already exist. So the lesson is only invest in crypto if you can handle massive swings and potential losses. Never put in more than you can afford to lose. So what's the best investment for you? It depends on your risk tolerance and financial goals. If you want high returns and can handle volatility, then you can go for stocks. But if you prefer stability and safety, you can go for bonds and gold. But if you want a balanced approach, then you can invest in a mix of stocks, bonds, and real estate. But if you love risk and speculation, then you can go for crypto but with caution. The final lesson from these asset classes, risk and volatility, is there is no one size fits all investment. The key is diversification because combining different asset classes to reduce risk and maximize returns will help you in the long run. Now tell me, which asset class do you feel most comfortable with so we can discuss in the comments. And can volatility be an opportunity instead of a threat? Yes, smart investors love volatility. Why? Because when prices drop, they buy great assets at a discount. Example, in March 2020, the COVID-19 crash wiped out 30% of stock value. 1 year later, those who invested then made massive profits, but those who panicked and sold, they locked in their losses. So the lesson is volatility is only a problem if you react emotionally. And there are 6 types of investment risk. What should you worry about? Not all risks are the same. Here are the major ones. One is the market risk, which is your stock prices fall due to economic downturn. Second, company risk. A bad business decision causes financial trouble. Third, inflation risk. Your money loses value over time. Number 4, liquidity risk. You can't sell an asset quickly when needed. Number 5, interest rate risk. Rising rates hurt bond investments. Number 6, currency risk. Foreign investments lose value due to exchange rate changes. Notice something missing? Volatility isn't on this list because it is not a real risk. So how to measure and manage volatility and risk? You can measure volatility by three things. One is standard deviation, which measures how much your returns vary. Another is beta. It compares a stock's movement to the market. Another is volatility index. It measures fear levels in the market. So how to manage volatility and risk? First, diversify. Don't put all your money in one investment. Second, think long term. Ignore short term market noise. Third, have an emergency fund. Avoid selling investments in panic. And number 4, stay educated. Know what you're investing in. If you fear volatility, invest in low risk assets but expect lower returns. So now, should you fear volatility or embrace it? If you fear volatility, you will always worry. But if you embrace volatility, you will see opportunities. Warren Buffett, one famous investor, famously said, "Be fearful when others are greedy and greedy when others are fearful." So the lesson is volatility is your friend, not your enemy. So the final takeaway from this video is that, do you need a financial expert? What are the final thoughts? If you understand volatility versus risk, you can invest wisely. But if you still panic during market swings, you might need help. That's why a financial expert like a certified financial planner, a CFP, won't remove volatility, but they will help you avoid real risk. So their final thought is, the next time the market crashes, take a deep breath. Ask yourself, is this volatility or actual risk? Think like an investor, not a gambler. Now tell me, has volatility ever scared you into selling? Let's talk in the comments. And if you need professional guidance from a certified financial planner, then click in the link in the description for more professional investment and financial guidance. And if you find this video interesting, give it a like, share and subscribe to our YouTube channel. Thank you for watching.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.